Welcome to Evolve to Succeed, the podcast that brings together entrepreneurs, founders, business leaders and experts to talk about their journeys and explore the link between personal and business success. I'm your host, Warren Munson, founder of Evolve, a coaching, training and development company focused on enabling business and personal success and creating a community of like-minded individuals. Whether that be through our peer groups, one-to-one coaching, our training and development programs for you and your teams, or through our content and events, our mission is to get the best out of each individual and inspire them to be better both in life and in business. If you want to learn more about Evolve, including our beautiful co-working space in Ashley Cross in Poole, then please go to evolvemembers.com, where you'll find great content, insights, details of all of our services, and also information on our forthcoming events. For now though, let's get on with the show. Welcome to this week's episode. Today we're talking all things investing with Tom Crosshill, who is an investment trainer and entrepreneur. Having spent many years on Wall Street, Tom has significant experience and insight into the world of investing. And since leaving the US, he's been on a mission to help business owners and other busy individuals become confident, passive investors through his training. To date, he has delivered his program to over 1,000 people across Europe. As well as demystifying a lot of investment jargon during our conversation, Tom talks about passive investing and how to select the right stocks, explains the difference between ETFs and index funds, lists a few things to avoid, including trying to predict the markets, and discusses how to prepare yourself emotionally for investing. As well as this, he's got a great background and story himself, so of course we delve into that. And he tells us how, of all things, he became an award-winning fiction writer. If you want to better understand investing, this really is an episode for you. Tom, welcome to the Evolve to Succeed podcast.
Thank you for having me.
It's great to have you on the podcast. The main part of our conversation today is going to be investments and, why should a business leader, business owner on their journey invest? And build that kind of wealth along the way and all of those kind of things and some of that kind of higher level strategy around things they may think about and things they may do. But I'm also intrigued, Tom, about you and your own story and your own journey. And you co-founded a European investment company, Indexo, which, as I understand it, went from zero to an IPO in just 5 years. So I'm keen to learn what are some of the sort of keys to that success for you, Tom.
Yeah, that was a pretty crazy story. I mean, we can get into it in more detail, but the basic idea is, so I'm from Latvia. I went to work on Wall Street for a while, but I came back to Latvia and I saw with some partners that like investment options were really bad. They were really expensive, very poor choices, and people are struggling to save for their pensions. So we came in and built this kind of pension company with half the costs of everybody else, and that got a lot of traction, and we managed to really scale it up.
So really that disruption piece was reducing the cost of investment, and that's what created the success, was it?
Yeah, absolutely. Initially, it was reducing the cost. And then, of course, as we provoked competition and other people reduced costs as well, it was being able to kind of explain investments in a simple, accessible way and get people excited about investing. Yeah, but initially it was, let's disrupt the market. Everybody's too comfortable. Everybody's too fat. Let's come in and shake it up.
Brilliant. And I suppose that's what a lot of people need to do to succeed, don't they? When they have a startup, is find their niche, find that disruption, and that's what you found. I mean, so you must have come from a corporate world. So how did you working on Wall Street, come in to start your own business, a startup? How did you find that transition?
Yeah, it wasn't necessarily easy. I think anybody who's run a business knows that at some point there's a big shift in your mindset. The shift from being an employee to thinking that, okay, I'm going to build something and scale something up. I think at some point in your life you just realize, okay, if I keep thinking as an employee and looking for the next job, even if I'm getting paid a couple $100,000 or potentially on Wall Street millions, I mean, it's still capped and you're still doing whatever your boss says. And if you get fired, you get fired, right? And at some point you want to stop selling your time and you want to start creating value. Now, it doesn't mean that you're actually going to make more money. I mean, arguably, I might be making more money on Wall Street if I'd stayed there than as an entrepreneur, but I'm having more fun, I have more freedom, and I'm not afraid that my boss is going to fire me.
Yeah, that life choice. Yeah, definitely. And, and good for you for doing that. I suppose while we're on the subject of Wall Street, I suppose the image of Wall Street is very alpha male, alpha female, dog eat dog, that kind of thing. I mean, how long did you spend on Wall Street? How did you find the environment? Is there any myths about Wall Street that you'd like to put right?
Sure. Well, actually, let me take a little step back just for context. So, I mean, I was raised in the Soviet Union, right? I was born in 1985, so I was born in Soviet Latvia. I was born in the family of two teachers, so it wasn't like abject poverty, but we lived like four people to a room, used clothes. Like if we could eat a banana or an orange, it was an occasion. So it was like the kind of environment where nobody had any money to investing and wealth that was totally foreign to us. So then I go to the US for school. I studied physics still as a penniless student with no money. And I get my first job on Wall Street. So suddenly I'm up against all these, working with all these millionaires and people from Harvard and Princeton and Yale and these wealthy American families. And so that was, I was really intimidated. I thought it would be like this kind of super, this, macho, difficult, challenging environment. And I wasn't sure how I could compete. But actually, I think maybe it used to be like that. I mean, Wall Street is still, there's still some of that culture, but I think it's mellowed out a lot, partly due to legal reasons, because everybody's scared of getting sued if that toxic culture is too strong. And also the other thing I kind of discovered is that, investing and finance, it can be tricky, but it's really not rocket science. It's not that difficult. Okay, initially it can be intimidating because all the jargon and everything else, it seems strange. But if you kind of take it one step at a time, it's really not that difficult. So I say that to everybody: don't let bankers in suits intimidate you and make you think that, oh, I can't understand this, I can't deal with this. It's really not that complicated once you get past the jargon.
Okay, well, hopefully we're going to sort of de-jargonize investment in a moment. But during the course of this conversation, but I'm really interested just in that little bit of story. And how did you overcome that? Because there must have been that little bit of imposter syndrome. And I assume the drive to succeed came from that, that family background, that, like as you say, not abject poverty, but, a background in your childhood when, things weren't necessarily financially easily. So that must have been the drive. But how did you actually overcome those fears of inadequacy, imposter syndrome when you arrived in Wall Street? Because we all go through that in different ways in life from time to time, don't we?
Absolutely. And I think there's a number of challenges. One is, imposter syndrome. And I've been generally throughout my life pretty good at just outworking it. Meaning if I feel the imposter syndrome, I will just work 3 times harder than anybody else. I will study things in the evenings or the weekends or whatever until I know more than everybody else, and then I can kind of get ahead. Yeah, so that's been okay. Yeah. But I think the bigger challenge is mindset. It's when you grow up first of all, in a communist country, right? And then in a family where investing is not really a thing, and maybe business is, there's no history of business. My dad has a small business, so I had some. I was fortunate, but there's no tradition of really entrepreneurship and all that. And then, it took me years to I had to be in the Wall Street environment to really consider that I might invest my money, and then it took me years to start thinking that, well, maybe I could be a businessman and I could, build wealth someday. It just seemed like something from a different planet. If you don't have it in your family, it's very easy. Like if your dad, if you have this around you, if your friends and your parents and everybody else, there's entrepreneurs and wealthy people, I think it's very different. And if you don't have that, if everybody's working for a small salary and the discussions are, well, where can you find a salary that's 20% higher, then making that transition, I think, is the challenge, to flip the switch in your head.
Brilliant response. Yeah, brilliant response. And switching your head when, that is not your natural background and you've got to make that transition in life as well. Yeah, I can, that resonates with me definitely. And I can see that could have been, that can necessarily be the bigger challenge because, as you say, everything else, you just work harder, smarter, get yourself educated and then you can be there at that table and compete. But you kind of got to learn to fit as well. So, nice to have that. Hopefully for our listeners, that's given us a bit of a background to you, Tom, put things in context, a bit about your story, which is great. But do want to go on and just talk about investments, because I suppose the first thing I would say is the thing I hear most, and I suppose I was guilty of this to an extent, was that we all think, well, I'm going to start a business, going to build a business, I'm going to sell a business, that's my investment, that's my pension, that's how I'm going to make it, that's how I'm going to become financially secure. And for many that happens, but it doesn't happen for all. Right. So, if you've got business owners, business leaders listening to this conversation, what would you say to them if that's the philosophy that they're following right now, Tom?
Well, I mean, first of all, obviously it can work. It can work. But on the flip side, there's two arguments. One, what if it doesn't, right? And the second argument is, well, why not invest and accelerate the process of growing your wealth, right? So what if it doesn't? That's one. I mean, I was recently talking to a multi-millionaire startup kind of somebody who exited from their first startup, and he's diversifying his investments, and he talks to a lot of other successful kind of startup people who have some millions and whatever, and for the first time in their lives, and he says a lot of people have this hang up. They exited from their first startup, they made a few million, and they want to put it all in the next business, but it's really stupid because the math of tech startups is such that most will fail. So if you've managed to make whether it's 50,000 or 100,000, like the first 100,000 is the most difficult, right? The first million is the most difficult. Why would you risk having to do it again from zero if something doesn't work out, right? So you want to kind of diversify the risks. Like with my current business, yes, I'm going all in, but I'm also keeping a bunch of other investments, and that gives me peace of mind. If this business were to fail for some reason, I'm not going to have to start from zero. I have the starting capital to launch a new business or whatever. So that's really important. But then the other thing is, even as I'm becoming more successful with this business, every time I take out dividends, I put some of that in investments. Because, well, it depends on your business. But for example, my business can only eat so much investment. Like it's not capital intensive. I don't need to put in a bunch of my money all the time. We're cash flow positive, so that's very nice. So in that sense, I don't need it all. And I can't get a good return in the business. And I want that money to be making a return, right? I want it to be making me more money so that, okay, I'm making money in the business, and my money is making me money outside of the business. And if I have these two things happening at the same time, I get rich faster than if I only have the business, okay? So that's kind of two sides. One is don't risk everything, and the second, just accelerate how your wealth grows,
Yeah, two great perspectives there. And actually, again, would resonate. You see so many, and we work with them, business owners, entrepreneurs that sell the first business and nearly think they can walk on water, and don't perhaps realize and remember the energy. There's not just the money, but the energy it took to start that first one and succeed and get the ball rolling. And so they start again and they try again, and not always to the same degree of success. And that kind of not putting all your financial eggs in one basket makes sense, but also that fact that a lot of businesses do, as they grow and succeed, throw off income, don't they? And it's then what if you can double up on that and do something with that income that's thrown off, you're creating wealth in more than one place and spreading your risk, which is great. But I suppose I'd go on to ask then, what's that very initial advice that you'd give that busy business leader, business owner who wants to invest, but perhaps doesn't have the time or knowledge right now and doesn't know where to begin? So what are the first steps someone should take, Tom?
Yeah. Well, the first step is actually to think about that claim that I don't have the time to do it, right? A lot of people say, I'll do it when I have a bit more time. But I don't know. One of my favorite phrases that I used to say in my family was, things are a little bit crazy right now, but like in a month or two, it should slow down. So then I'll do it, right? Right, because today your calendar is full because it's right it's right there, and by the time next month comes around, it's going to be full again. And actually, what effective investing, passive investing can do is free up time for you down the line. But if you don't start doing it now, it's never going to do that, right? So it's actually kind of a high priority to start doing it. But then the second thing I would say is it's a little bit self-serving because I'm an investment trainer, but it really is that you need to get educated a little bit. Because the way I think about it in life, okay, there's three parts to building wealth. There's making money, and we spend a ton of time and effort on that. Yeah. There's saving money, and a lot of people spend a lot of effort on it, and we make sacrifices. We don't buy that fancy car or the big TV or whatever because we want to save, right? So we put energy into that. And then there's investing. And a lot of people kind of treat it as an afterthought. They just read something online and they jump and do the same thing, or they just trust their banker, which can be fine, but they'll end up paying 1.5%, 2% per year in fees, which eats up a lot over time. Instead of taking a little bit of time to kind of educate yourself, because it's an important part. It's like 1/3 of the big picture if you want to grow wealth. You want to kind of educate yourself. So we can talk about next steps, but those are the first things. First, to understand that there's never going to be a great time, and you kind of need to find the time, you need to make the time. And second, it is important to kind of educate yourself a little bit before you give somebody your money. Yeah.
Okay. Brilliant. And I'll just pick up one of the things you said, because you talked about passive investment rather than somebody really actively investing and managing your funds. I mean, is that a core philosophy that you have, Tom?
I think it depends a little bit on what you want to do in life, but I would imagine that for most business owners, I mean, we have our hands full, right? I mean, you're running your business. Like, when are you going to sit there and read the financial statements of 50 different companies to select the 20 stocks which you think are great so that you're active investing? It's really time consuming. So if you have a business or a high powered job or whatever, it's not really a great fit. Yeah, so you can either do it sloppily and probably not get very good results, or you can go passive. Yeah, and my philosophy for most people, yeah, for most business owners is, okay, I'm active in my business and then I have some cash flow and I want to invest that passively. Okay, so I can focus on my business and focus on making more money. I'm probably better at my business. That's probably the best way to make more money than spending a whole bunch of time to learn investing with the hope that I might get a slight uptick in my kind of annual return, which most people don't. Even with a lot of work, most people don't. Yeah, most people, active investing doesn't work for them, right? So yes, I'm a big fan for passive investing, unless you want to be a full-time investment professional.
Brilliant. And I suppose that's the piece, isn't it? Around, let people play to their strengths, and therefore, if the strength is running a business, creating the wealth, do that, and then do something different. So how do you define passive investment?
So passive investment is, I mean, honestly, of course, there's no investment that is absolutely 100% passive without doing anything. But a passive investment is one that takes as little time and effort from you as possible. And the best kind of passive investments, for example, the passive part of my portfolio takes me literally 2 to 3 hours per year to manage. Okay. Initially, you need some time to set it up, to figure out how it works, to learn. But once you have it going, so it's not a secret then, like index funds and ETFs, if you know how it works, if you set up your portfolio, later it's maybe a few hours per year to kind of keep an eye on it, make sure everything is going the way it should be.
Okay. And what's an EFT?
So ETFs are exchange traded funds. Yeah, it's totally fine. Actually, even though these are some of the most popular investments in the world, when I do webinars for people across Europe, I usually find that only maybe 20 to 30% know the details, and 20 to 30% have heard the name, and everybody else hasn't even heard the name. So it's important to kind of take a step back and understand how that works. So take a step back, we actually need to go quite a ways back. We need to go back to, okay, where do you want to invest? Yeah, if you have some money, where do you want to invest? Do you want to gamble? Which is like trading Forex or day trading stocks, buy and sell, or crypto or whatever. But these are, first of all, this is active. Yeah, it takes a lot of time and energy. Yep. And second, it really is gambling. Some people, same as with poker, some people who are really good at it can make money. Most people don't end up making money, right? Or you can invest responsibly for the long term. And if we talk about long-term investing, the two big proven investments over the long term are real estate and stocks. Real estate and business, basically. But stocks are the easiest way to invest in business, right? Okay. So real estate has its own set of challenges, managing properties, dealing with tenants, doing repairs, all this stuff. It's fine if you love it, if you do it, you can do it. But let's just put it aside for a second. Let's assume you want to invest in the stock market. And there we come to the problem that I mentioned before, like nobody has time to select the right stocks for your portfolio.
Yeah.
Right, exactly. Yeah. So that's where index funds and ETFs come in. Yeah, an index fund, it's a very simplistic example that I use is, let's say you go to a candy store that you've never been to before. There's a whole bunch of candy. You don't know what's good. You don't want to risk buying something that it's some kind of weird licorice that just tastes gross, right? So instead you buy a bag of everything, and that's a kind of good solution. Well, an index fund is a little bit like that, but for stocks, yeah. As an amateur, it's very difficult to say which companies in the stock market are going to perform better. Okay. And actually, people don't understand that virtually all the companies in a major index, like the FTSE 100, the S&P 500, whatever, I mean, these are big, successful companies. It's not like, yeah, there are some good companies and then there's a whole bunch of really crappy ones. I mean, most of them are quite big, quite successful if they've made it that far, right? So it's really, really difficult to pick which ones of these are going to be more successful.
Who's going to outperform who is really difficult to determine at that point, isn't it?
Exactly. I mean, even professionals don't really succeed at that. So what an index fund or ETF does is it says, okay, let's just buy all of them. Let's buy a little bit of all of them, and you get the combined result of all these companies. So that's the approach. It's what Warren Buffett recommends for most people. It's what a bunch of Nobel Prize winners recommend. You just invest in the whole economy with very, very low costs. And index funds and ETFs are just how you do it. Now, the difference between an index fund and ETF is technical. An ETF is something you buy on a stock exchange like a share. An index fund is something you get directly from the provider like Vanguard or HSBC or through a fund platform. But if this is your first time hearing about it, I wouldn't worry about it at all. The basic idea is instead of picking separate funds, you invest in the whole market with very low costs. And it just historically, it has been a really smart way to invest.
Brilliant. Thank you. Thank you for explaining that. That was a brilliant explanation. And I suppose when you're then talking about investment and you're talking about not gambling, because the gambling is I want to get a return and I want to get it in a short to medium term. What timescale when somebody is investing in an index fund or an ETF, do you think they need to think they're going to invest over?
So this really it's kind of an art of figuring out, okay, what is my timescale, and then based on that, what are the appropriate investments? So if we're talking about just stock index funds or stock ETFs, so investing in the stock market, well, typically you would say the minimum is maybe 5 years, and you're probably more comfortable with 7, 10 or more years, because the reason is that in the short term, the market does fall. It does happen regularly that over the short term you have losses. Actually, around 1 in every 4 years, you see a loss in the stock market, right? So if you're just investing for the next year, I mean, you can end up losing a bunch. And then if you need to sell in that time, it's really painful. But over the long term, the statistics are much, much better. The stock market has always gone up because you're investing in real companies which are making money. So as long as there's no Armageddon, I mean, you can generally expect the market to go up over the long term. So that's why for long-term investments, stocks have been fantastic. Now, if you need to invest for shorter periods, that's where you start adding kind of less risky and kind of less profitable investments to your portfolio. The typical solution would be bonds or bond funds. There are also bond index funds and ETFs that you can use that kind of simplify your life. So, for example, if you're investing for 3 to 5 years, maybe you might either buy a few short-term bonds or a bond fund. A couple of years ago, it was not interesting at all because rates were like around zero or negative interest rates, I mean. But today, I mean, it's becoming more interesting again as rates have gone up around the world. So now that option is on the table again.
Okay, brilliant. Thank you. And we've talked about, I think we've probably talked about some of the common mistakes that people make when they start investing. Perhaps they're being too active themselves, they're going into risky investments, they're not investing for the long term, they're not making those decisions. Any other common mistakes that you think people make in those early days of investing?
Definitely. There's a bunch. One that I would highlight is not having your safety cushion. So, for example, if you're a business owner, And let's say you take out your quarterly dividend or whatever, and then, okay, you say, okay, well, for the next 3 months, I need whatever the amount is, £15,000 or something. I put that aside, and then everything else I invest. Then it's not really a smart idea, because, I mean, what if there's a slowdown in the economy? What if next quarter's dividend doesn't come on time? Whatever. What if, there are other challenges and you need a bit more money? So you typically want to have a safety cushion that's a little bit bigger, that you don't invest for these eventualities. People who have a really stable government job might have a smaller safety cushion. Somebody who has a small business in a kind of sensitive industry that fluctuates a lot, you might want to have a bigger safety cushion. Because what you don't want is to buy a bunch of stocks and then suddenly the market is down, the economy has slowed down, you don't have income, and you have to sell those stocks at a bad price, right? So you want to have some safety cushion that you don't invest before you start investing. That's one big mistake.
Brilliant. I think it's a great one, and not one that you'd easily think of, would you? You think, right, I'm all in, I'm going to go.
Right,
actually,
exactly.
Yeah. And then you have to make some, if you do need to step in, it feels like a negative decision, and if that bit's at a loss, that could just throw your confidence off completely in terms of investing. So great advice there, Tom. And, as we're seeing it, we get bombarded, don't we, with a kind of flood of adverts for apps and, I suppose, get rich quick investment, gurus and all of those kind of things out there. What's your view on, the apps that are coming out and, some of that kind of guru stuff? And Tom, I'm not putting you in that category. You're very much, in everything I've read about, that kind of, train people to invest for themselves for the long term, rather than let's get rich quick. But, you're up against that as competition, aren't you? The apps and the gurus.
Absolutely.
What's your view?
Yeah, so it's actually kind of a complex issue. There are certainly many benefits to all these fintechs and trading apps out there, because they've provoked a lot of competition and they're driving investment costs down, which, like the big old investment houses and banks used to feel really comfortable. They're fat fees and commissions and everything, and they've been forced to reduce that because of all this competition. So that's wonderful. For long-term investors, I generally am cautious with a lot of these new apps. First of all, if they're regulated, so you want to make sure it's a licensed, regulated company, whatever you're using. Yeah, so it might be licensed and regulated by the FCA, or maybe it's regulated in Cyprus or Germany. But somewhere in a reputable country, you want to have some regulator watching them. If that's the case, okay. I mean, that is already very significant, because most investment companies, they have to follow strict rules that client money is held separately from the company, and so in general it's fairly safe to invest through them. That said, when looking at these new apps, I generally would prefer them for active trading, when I'm putting in some smaller amount of money and I'm playing with it, and I think they can be brilliant for that if you're into that. I'm not, but if you want to do that, that's a good solution. But if I'm investing my family's wealth, which is maybe tens or hundreds of thousands or millions potentially, then my bias is to look for financial houses with quite a long track record, a very good, strong reputation, a good, strong financial position. Because even though my investments are legally protected, I'd much rather never have to test that protection in real life. Because if something does happen, usually the protection works brilliantly, but there have been some cases with some major brokers that did go bust, where it can take a few years for you to get your money out, and that's already not fun, right? So for long-term investing, for investing large amounts of money, I tend to prefer bigger, older, more established financial companies. Yeah. Of course, watching out for those pesky fees at the same time.
Yeah, pesky fees. I like that.
Yeah.
Yeah, and I suppose that the fees piece is a piece around, why you like the index funds, the ETFs, because they're lower fee based and more of the return comes to you. I assume that's the case. Is that a right assumption?
Absolutely. Of course, there are no guarantees in investing. There's only statistics, but statistically, index funds and ETFs in pretty much all industries, historically over the long term have beaten most professional investment funds. And the key reason, one of the key reasons, is that they have much lower fees. And that is directly management fees, and it's also all kinds of expenses. Because when you have these active funds which buy and sell a lot of stocks, every time they do that, they incur expenses. And index funds do that a lot less. Okay, so that's why they have been. That's one of the reasons why they have been so powerful.
And if we look at the kind of investment market at the moment, we're sat here now, just early part of February 2023. The markets have had particularly in the UK, they've had a really strong bounce. Going to ask you the big question to get your crystal ball out, I suppose. Where do you see funds, stock markets going during the course of 2023, Tom?
So this is one of my favorite topics that I preach a lot about. Stock predicting, market timing, these things don't work. It's really a waste of time to do it, and it's even a bigger waste of time. It's actually a big risk to listen to people doing it. There's a reason, I think it was Warren Buffett who said that the only point of stock predictions or stock predictors is to make fortune tellers look good. Because fortune tellers, by comparison, look like they're really smart. Like there's a whole industry. You'll open up the Financial Times or Wall Street Journal or Bloomberg, whatever, and you'll see all these articles saying that either it looks like it could be a great opportunity and we're about to see a pickup, or just today I opened up the news and some big short seller was saying sell, it's time to sell, and any of them might be right. I mean, maybe the guy's right. Maybe somebody else is right. But there's scientifically, there's no reason to believe any of them more than anybody else. Market timing really, really doesn't work. And the reason is that the market is complex and it's watched closely by thousands, if not millions, of smart investors around the world. So the current level of stock prices, for example, it reflects the consensus of the market of where we are and where we're going. Yeah, so the current market level already reflects some worry about the future. Yeah, it doesn't reflect the perfectly beautiful picture of the future, right? It reflects what the market thinks might happen with the economy, with inflation, with the war in Ukraine, and everything else. Now, if we go ahead and things happen more favorably than expected, then the market might go up. If they happen less favorably, then the market might go down. But predicting that smarter than the market is virtually impossible. So I really recommend against trying to time the market and make these predictions. And instead, the smartest approach to investing has been for a long time, which is regular investing and not stressing out. And don't let yourself stress out. I was buying a year ago when prices were higher. I'm buying now. I'm happier now that prices are lower. I'm still buying. If prices go down even more, I'll be even happier. I can buy them even cheaper. If they go back up, I'll also be okay because my portfolio's up. Right? You try to kind of look at it from a long-term perspective. Yeah. Like you're going to be fine. I make regular investments because I know that is the kind of smartest way to invest over the long term.
Yeah, it's a very philosophical way of looking at it in a great way. And there is that adage, isn't there? Is drip money in to the market. Yeah. Whatever the market price is, just drip market in. And as you say, that's a proven success and technique. And I must admit, recently sold, as listeners to the podcast know, the core business I had, having sold some smaller businesses along the way on my journey. And put some money into funds and did that kind of, the advice I had was, right, put it into some funds, put the money in there, drip it in over a period of time. Don't put it in one lump sum. But the other thing was, the question was, did I want to be able to track what those funds were doing on my phone? And I went, no, don't give it to me. I just tell me once a year, because I think you can react emotionally, can't you, at times? And I suppose everything you're saying on this during the course of this conversation Tom, is try and take that emotion away out of investing and be more practical and be more pragmatic about it. Is that right?
The way I usually put it is we can't turn off our emotions. We know that there will come. So it's good to educate yourself to know what kind of things happen in the market. And I actually always encourage my students to prepare themselves emotionally. I actually encourage them, okay, imagine it. the big crash comes and you're looking at your account, and if you're all in stocks, then you'll see it's down 40% or even down 50%, like in the big financial crisis. You see that you've lost whatever, 5,000, 50,000, whatever is, the amount for you. Prepare yourself for that. If you're investing for a 20-year time horizon, for example, you shouldn't really care that much. You can keep investing, but it's gonna suck. It's not gonna you're not gonna be a happy time. So prepare yourself for that. Talk it over with your spouse. Yeah, so that you're not in this situation where this happens and your spouse is threatening to divorce you because you lost a bunch of money. Agree that this is this appropriate? Is this level of risk appropriate? If it is, then commit that, okay, periodically these crashes and things happen, but we're going to be fine. We're going to keep going. If you don't want to take that risk, then don't take it. Think about it ahead of time. Prepare yourself. And if you're prepared, and if you've kind of imagined what it's going to feel like, if you've discussed it with your partner, you're much more likely to be successful than if you kind of what really upsets me is when people just listen, they just get enthusiastic about investing, and they just give some money to a banker. Yeah, let's put it in the market, and then the market goes down, and then they blame the banker, they blame the market, they blame everybody, which is understandable, but it's not really the banker's fault if the market goes down. Of course, they're kind of responsible for maybe not explaining it better, but it's also on us. You have to be educated. You have to understand. Like, if you're putting money in the market, you are taking risk. Yeah, you want to make money. If you want to make money, you got to take risk. You got to prepare for it, and if you prepare for it, then you're likely to be successful over the long term.
Okay, brilliant. And on that subject of risk, I suppose we should talk about entrepreneurs, business owners, founders. They're naturally probably on the higher risk taking scale than Joe Public, and so therefore they might be interested in crypto or a very specific stock or a particular sector or something they've heard about. So if they are being sensible with a proportion of their investment, would you advocate that freedom to if it is money they can afford to lose, doing something different with it? Is that part of your philosophy as well, Tom, or would you always say play safe?
Well, I think there's this approach that's called core and satellite, which is where you have maybe 80 or 90% of your portfolio in the sensible thing, and then you play with 5 or 10 or 20% because you want to, and you don't have these expectations that you're necessarily going to win, but you just want to play. And I'm not against that. I mean, if somebody wants to do that, I think it's reasonable. What is important to understand is that, first of all, when it comes to individual stocks or individual sectors, just because you have a brilliant idea, you should be aware that probably a million other investors have had that brilliant idea, so the price probably already reflects that, so it's not that easy. And with a lot of, crypto and everything else, that's a separate conversation. I don't know if you want to go there, but
I'm gonna have to go there quickly. But so what's your view on crypto?
Yeah, well, I know this always makes me some enemies, but I'm not a fan. I think it's one of the biggest wastes of time and energy in I don't know, history. There's so many smart people have spent so much time and energy thinking about something and working on something that doesn't actually serve any real purpose. I mean, there's some there's some benefit, but really very limited. I look at it like it's. You look at a truly useful technology like the internet, or now we see AI and these AI tools coming out, and you see that it's hugely demand driven. People are running out there using it because they see the potential. They see how they can make money. They see how they can get more productive or have fun with it or whatever, right? And that's a sign of a really kind of potent technology. And then I look at blockchain and crypto, and it's all supply driven. Like, I've yet to meet anybody who themselves was not speculating, who was excited about actually using blockchain for anything. Like, if they don't own crypto, I haven't met anybody who doesn't own crypto who's like, oh yeah, I really want to use blockchain to solve this problem or that problem. Like, it's like virtually doesn't exist. There's no real. There are some like, okay, for crime and for some of these other things, there are some use cases, obviously, right? Maybe in countries where there's no rule of law and there's all these other problems, but mostly I see is that it's very much supply driven, like it's pushed by a whole bunch of shills who build castles in the air about all these applications and uses for it. whereas in fact I just don't see it. So it feels like a waste. From an investment perspective, even if I'm wrong, I'm not the smartest guy in the world. I can be wrong. Let's assume I'm 100% wrong. Even if I'm wrong, and blockchain is a fantastically useful and important technology, buying coins, it's not investing, it's speculating. Yeah, You're trying to guess which coin is going to go up, which coin is going to go down. Maybe you buy Bitcoin, but in fact Ether is going to go up. Maybe you buy Ether, but it's something else that goes up. You might be right, you might be wrong. It's a fairly active thing to do. It takes a lot of effort to follow all this market and the news and everything else. So again, this is more like gambling than long-term investing. Even if I'm wrong, and even if this technology is going to be really fantastic and cool.
Brilliant perspective, Tom. Thank you for that discussion around investment. I just do want to finish on a couple of things about you as an individual. So, as well as being an entrepreneur, as well as delivering and developing the investment training business, you're also an award-winning fiction writer, I read. Wow, that's quite a diverse mix. So what got you into writing books, Tom?
Well, I guess I was writing before I was doing anything else. I mean, I was writing at the age of 7 or something when I read a children's book that I didn't like the ending of. So I started writing a sequel.
I'll write my own ending.
Yeah, exactly. And then I was writing it as a teenager. It was just, I loved reading fantasy and science fiction growing up. That's how I got into English. Actually, I was reading books in English because there wasn't enough fantasy and science fiction in Latvian, and so I was reading it, and I started writing in English as well, and it was just this big ambition of mine. And then when I actually moved to the States and lived there for a few years, and my language skills got even better, and so I started getting published and winning some awards and getting nominated, and so that was really rewarding, this childhood dream that came true. So I've had a couple of novels out. I had a novel about Wall Street, actually, partly about Wall Street and partly about like Siberia and Soviet exile, called The Cattle Express. And I had a novel about dancing in Cuba for young adults called The Cat King of Havana. So I put a few books out. But that was all before I started this Indexo company. I have to admit, since I started that ride, it's been a little difficult to find the time for writing books.
Brilliant. Hopefully you get to find that passion again in the future. Yeah. So just to really round up, I always end with this question, and I'll end it with you. We've talked about what success may mean for you in terms of investment and those kind of things, but from a personal perspective, what's your definition of success, Tom?
Yeah. That's a tough question, right? There's so many layers to that. In some ways, I already feel very successful because I have a loving family. I'm fine resource-wise, so I don't need more money. Mm-hmm. I can have I can have a nice walk in the park in the morning, and I feel happy about that. So there's so much that makes me feel like I'm successful. But then the other thing that I think about these days is, because I have 2 little children, and I'm seeing what's happening with the world. For example, these AI chatbots, right, that are coming out, which seems like a funny little thing, but it's going to really change the world. So I'm reminded of, I forget which Greek philosopher it was that basically said that you can't be called a happy man unless you're dead and your children are dead and they all had basically happy lives. Because, what if you die and then the world changes and it's difficult for your kids, right? So now I'm thinking in terms of long-term success, of setting my family up for success. If the world is really transformed, if many professions disappear, if AI becomes a big factor, So it's actually an interesting period. I think the next few years are going to be a period of huge change, and I think we all should think about how do we position our families to best kind of navigate these changes.
Brilliant, great thought-provoking response there, Tom. And you're right, aren't you? I mean, AI is going to change, and I've got 2 kids, and how does that change the world? And how can we get them, as parents, better prepared for them to find their way through life? Definitely. Love that response. So if people want to learn more about Tom, they want to learn more about your investment training, where can they go?
Yep, so you can go either to my website, which is tomcrosshill.com, or you can sign up for one of my free webinars, which is at go.indexmasterclass.com. Hopefully maybe we can put the link next to the podcast description. And so these webinars are especially for European investors, and that includes UK investors. So I'd be happy to see anybody there.
Brilliant. Thank you, Tom. I love conversations where I leave the conversation more informed and knowledgeable, and this has definitely been one of those conversations. So thank you for being a great guest on the Evolve to Succeed podcast.
Thank you for having me. It was a true pleasure.
Thank you for listening to the Evolve to Succeed podcast. My hope with every episode is that you've learned something new or heard something that challenged your way of thinking and further motivated you on your path towards becoming a more knowledgeable, informed and inspired individual and business leader. If you enjoyed this episode, then please help us by rating, reviewing and subscribing. We really value your feedback and would love to have you along for future episodes. And please don't forget to learn more about Evolve by going to evolvedmembers.com. Thank you for listening. See you next week.